It's described as nothing short of breathtaking, a points drop never before seen on the US markets.
Young, hungry and disciplined, BNF is anxiously trading to make a living. But the market he faced was an unforgiving bear market. As you know, in 2000, the global stock market had just been hit by the burst of the internet bubble, aka the dot-com bubble. But what you might not know is Japan had already experienced a huge asset bubble burst in the 90s. It was known to Japanese economists as the lost decade, where assets prices dropped over 70%, a decade of terrible economic pain. Despite studying the charts for 2 years, BNF started suffering initial losses. However, through his experience, he quickly developed a strategy that was simple yet brilliant. In a bear market, the overall sentiment is fear. People hate losing and think positive upswings are unlikely on the short term, so they underestimate their likelihood. His strategy was contrarian trading. BNF found when traders are fearful about the overall bear market, they will often oversell falling stocks to avoid the pain of losing. Or in BNF's own words, when going for a short-term rebound, what you should focus on is the moving average divergence. In the bear market of 2001, I would only look at stocks deviating at least 20% off the 25-day moving average, with 35% being somewhat a safe level to buy. Price would then surge, and I would close the trade in a profit. But it wasn't that simple. Even after stumbling upon this revelation, a lot of BNF's trades were losses. With more losers than winners, it was painful to see his hard-earned savings shrink. To him, it seemed like some sectors of the market were trickier than others. Despite the pain, he knew it was unrealistic to expect overnight success. Instead, he decided to focus his mind and double down on analyzing his losers. From studying the losing charts, BNF had realized his losers were repeatedly the same sectors, and each of them had different repeating deviations. He concluded the divergent percentages were different per sector, or in BNF's quote from his old 2-channel posts. For the service sector stocks, the range of deviation from the 25-day moving average was between 22 and 30%. For the post-dot-com crash IT stocks, the ranges were 25 to 45%, and for emerging stocks, it was 28% to 60%. Applying different numbers per sector allowed him to find greater entries to the temporary upswings. BNF had learned he first had to develop a feel for the sector before being able to make a trade. With his intense focus, he was producing more wins than losses. But by December 2001, the bear market got even more insane.